Good afternoon, everybody, and welcome to this week's weekly macroeconomics session for this Friday, the 19th of June 2015. We're nearly halfway through the year. Time has certainly flown. As they say, time flies when you're having fun. Speaking of fun, I've got with me, as always, Jeff Saffer, head of the Elite Investors Club. Welcome to you, Jeff.
Thank you, Dave. Hello, everyone.
Jeff's got a bit of a cold at the moment, so if you hear a little bit of coughing, please forgive him. He's been a little bit sick, but certainly keen and eager to discuss the macroeconomics with everybody today. So let's get stuck into things. First of all, the disclaimer, and again, the content of this presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your investment objectives, financial situation, nor particular needs. So please, before making an investing decision based upon the general advice presented in the following, please consult your licensed authority, whoever he or she may be. All right, just a reminder that we have coming up at the end of August the 29th through to the 2nd of September, our Elite Traders and Elite Investors Academy. We've got a really good program. We're releasing a couple of webinars over the course of the next couple of weeks, giving you a little bit more detail, a more in-depth look at the Academy, some of the guest speakers and some of the topics that they'll be covering. Some really good material, so I encourage everybody who's got that time off or can get that time off to seriously consider coming along. It's a lot of fun and you're certainly going to learn a lot as well. All right, so let's get into things. The week in review. Australia, we had the monetary policy meeting minutes come out on Tuesday and the RBA bulletin yesterday, Jeff. This week also in the US we had some data, some very important data, some market moving data as it turned out to be, and we had some news out of the Eurozone in terms of how the folk over there are feeling, in particular the financial institute guys. So we'll talk a little bit about that. First of all, in Australia, Jeff, RBA, what do you make of the policy meetings minutes?
Yeah, look, there wasn't a lot of groundbreaking news coming out of it. Obviously, we had the rate cut in May, we had rates on hold in June, and we got the original decision on, I think it was the 2nd of June. So this is just the minutes explaining the rationale. At the end of the day, the RBA sees the Australian economy ticking along slowly. Notes obviously the property market's doing okay, business confidence is sort of neutral, but still seeing obviously a big slowdown in mining investment, and wages are pretty soft. So they basically just said things are okay, but certainly not going gangbusters at all. So expect sort of low to average growth, and inflation's under control. So none of that is really too new, but they basically signed off with, look, rates are fine where they are, will be dictated to by the data. So they're basically saying, look, don't expect anything unless the economic data really gets a lot worse.
Yep. I was having a bit of a look at the I think it might have been the bulletin I was reading yesterday, and everybody who's at the RBA contributing their thoughts, etc. So it's all written as, you know, the board noticed this, the board noticed that. But I was surprised that they actually mention they go and have a look at other countries and what's happening in other economies as well. Is that typically something that they do, or is that just out of the blue?
No, that's very much a part of what they do. And even in their so the RBA bulletins is it's a quarterly report. It's kind of like a lay of the land for the global economic picture, obviously with a focus on Australia, but looking at all the factors that influence how we do over here. Yep. In their monetary policy meetings, so their monthly meetings where they're talking about interest rates, they start off actually looking at the overseas conditions, mostly in terms of our main trading partners. So they don't worry too much about areas if it doesn't sort of affect us, but they are constantly looking at the US, China, Europe, and Japan somewhat as well.
Yep.
So they take into account everything.
Yep. A little statement there above Janet Yellen's head. It says, we're looking for a decisive evidence to justify a rate hike. I suspect that evidence will not arrive prior to the July meeting. Maybe September, maybe not. It's all meeting by meeting, you know. Interesting. I'm not too sure what to make of that. It doesn't sound as though they're entirely sure when they might start with their rate hikes. Now, this week, Jeff, we had some very important information come out of the States. Is there anything in the data that came out, any of these numbers on the screen here, that might be that bit of decisive evidence that they're looking for?
No, I don't think so. So obviously they kept rates basically at zero, so 0 to 0.25%.
Yep.
Like you said, they this month was as early as people were expecting the rate hike to come.
Yep.
They kept rates on hold, and really the prospect is, when are we going to see that first hike? Janet Yellen said that, and the dot plot, which is graphing all the individual members' expectations on a chart, basically says that we'll probably see 2 rate hikes this year. What's interesting is that not every meeting has like a press conference. So if anything, the meetings that have the press conferences will be the ones where they do raise rates, and those are September and December. So if you're a betting person, you'd probably pick September and December.
Yep.
But the Fed is, for the last 12 months, has more talked about raising rates than really taken the action. So they're kind of hinting, hey, we could raise rates in the next few months. We really could. It could even happen next month. And it gets to next month and they say, oh, we're not raising rates, but we could do it really soon. So it's, I think they're actually trying to warn and signal more than they're actually trying to take action. So it wouldn't be crazy to even to see rates stay until maybe December.
So it's a little bit like what Glenn Stevens does over here, where he really tries to talk the dollar down.
Yes.
Because he's wanting a weaker dollar. And sometimes the market listens and sometimes the market doesn't. At the end of the day, the market will decide where it wants to be. And I guess they're just trying to have their little say, I guess.
Well, both of them can act and move the currency around,
Yep.
And by changing rates, but they can also be influential by hinting at what's going to come, and they actually probably use the hinting more than they use the action, if anything.
Yeah. So some data there, Jeff, you were just pointing to?
Yeah, so I mean, obviously industrial production missed expectations. Now, I'm not sure on the exact number, but I have a feeling that is possibly the 6th month in a row that industrial production has missed expectations.
Yep.
And obviously, if you are going to start raising rates, you really want to see that economic strength, which is not really coming through.
Yep.
CPI... and core CPI are both underwhelmed.
Yep.
So, and again, that's probably going to push things back as well. If you're not, if you've got lower CPI, you can actually afford to sort of start putting up rates. But I think last week I said I'd be surprised if we saw low CPI. So this is quite surprising. The last few months we'd seen at least 0.2 on the core. So that was one out of the box. That was quite unexpected.
Yep.
And the Philly Fed Manufacturing Index really blew expectations away. So that was a good signal, which goes against what the industrial production numbers were. But that suggests that, look, maybe manufacturing might rebound in the next couple of months.
Because certainly last night when that data came out, the market was a very strong night in the US last night on the back of that manufacturing data. So interesting there. It's been a while since we've had a big strong session, so it was good to see that. In the Eurozone there, Jeff?
Yeah, look, I think I might have predicted a reading like that last week.
Yep.
We had a really big fall in this survey last month, and another big fall this month as well. So this is basically economic forecasts coming out of confidence levels from German investors. So that's obviously taken a big hit. It's still very positive. So if it's above 0, it's positive. But you can see it was close to 50, 2-3 months ago. So that confidence is eating away, partly because of what's going on with Greece, and partly because the German conditions are just generally sort of weakening a little.
Yeah, yeah. So we're really going to have to wait until the end of the month and see what happens with Greece, whether they default on their loans at the moment. I have seen some news articles where they're continuing to tap emergency funds to pay for pensions and all those sorts of things. So that's kind of scraping the bottom of the barrel, isn't it?
Yeah, well, just actually interesting on the pensions. The Europeans have come back and said to the Greeks, this is one area where we need you to. I think pensions make up something like 16% of Greece's GDP, so it's a massive, massive spend for them. And the Europeans want them to cut down pension payments further, but that would actually put them pension payments, I think, below the technical poverty line. So the Greeks aren't retirees aren't just sitting back on little islands eating expensive fish and meats and whatever's. It's a pretty tight ship in a sense. So, but that's pensions is actually going to be a big part of the discussions.
And big social issues there as
yes.
well. Yeah. All right. Well, with all of that as the backdrop, let's just go and have a look at what's happened on the markets the last couple of weeks. Certainly our local market, the XJO, has been really having a very difficult time since about the early middle of May, when we went from low risk into moderate risk, and then more recently getting down into high risk. Now, we have talked even last week about once we get below this 60 on the stochastic, that the propensity for the market to fall away quite quickly tends to increase. At this point, the market has tried to rally back up. As of yesterday, it put in a big down day, and the really concerning thing from a technical point of view was, if we just have a look at some of the old levels of what were support acting as resistance zones of recent times, and again that occurring where we had a strong demand zone now turning into a strong resistance zone. So today being a very strong day on the markets, it looks like we may well close back up above that 5,600 level with a bit of luck. It's still going to take a little bit of work to drag us out of high risk for the time being. So we'll just have to sit and watch and see what happens. But certainly at this point in time, I wouldn't be adding any new trades into your portfolio. Let's just wait and see what pans out. If we go across and have a look in the US markets at the moment, the S&P 1500, our benchmark there, around about this time last week, we just dipped down into moderate risk, and I was saying at the time that depending on what happens over the course of the next few days, whether or not we get back up into low risks, how long that was going to take. So you'll see here that we were down in moderate risk, and we had a big up day. And we were still in moderate risk. Now, with a little bit of strength following through this week, and particularly last night, it's just pulled us back into low risk, and you'll see at the top of the chart here the low risk print of 100%. So 100% of your maximum allowable drawdown, your maximum value at risk, you're allowed to have allocated into the markets. I'll just have a look at a couple of other international markets as well. That's the German market. Starting to find a little bit of support here at the moment. I think this market, a lot of the European markets are going to remain volatile until the end of the month, until we know what happens, whether that ends up being disastrous or whether the markets find some level of support. That's the German market. The Nikkei, just having a little bit of a breather at the moment. You'll see that historically, fairly clear that it has a bit of a run and a bit of a pullback, a bit of a pause, a run and a pause. Same sort of theme happening as well. It has been a very strongly performing market so far. They're just putting in a little bit of a lower peak there at the moment. We'll just have to wait and see what happens with that. But again, it's been a very strong market, and certainly one that you could access through an ETF and do quite well out of. The Shanghai market over there in China, again, a couple of weeks ago we mentioned this great big down day, which was down about 6%, I think it was, for that particular day. Certainly that would be headline making over here if our market fell 6% in the day. Following day it was probably down, not quite that again, but rebounding and moving on to higher. But the volatility, you can see the range of these candles is really quite long compared to the earlier parts of the overall trend. So volatility really expanding. And again, starting to see a few big black candles going in here. I think a few concerns about levels of margins, caps on banking requirements and those sorts of things. So obviously having a bit of an impact there in creating that increased volatility.
I mean, potentially, not necessarily calling it here, but that's the kind of price action you might see towards the top of a bubble, where you've got very consistent price action earlier, as you said, sort of smaller candles,
Yep.
and then it starts getting wild, goes on huge up runs,
Yep.
massive pullbacks, and then the euphoria kicks in as well, and it goes to new highs. So it's not necessarily, it doesn't happen at the switch of a button.
Yep.
But even the rally to get back up to the highs has taken huge volatility.
Yep.
That's, to me, that's quite concerning.
Yep.
Yes, there's some nice big lower shadows there. So every time the market gets sold off, it bounces back well.
Yep.
That's a bit scary, I think.
Yeah, absolutely. I mean, obviously a lot of volume being pumped into this exchange and out as well. So looking at volume in association with these candles certainly makes sense. So that's something you can all do at home and put on your volume and have a bit of a look at that. What we've got here, this is the Hang Seng. This is the Hong Kong market. Typically following a little bit of what was happening in China, being really strong. But just recently, just really starting to get the wobbles at this point in time, and I think probably a bit of a reflection of what's going on in China as well. The last one I just wanted to have a look at. This is just another European market, the Italian market, which again had been quite strong, holding up a little bit better than what its counterpart over in Germany was doing as well. So just interesting to see what happens with this. Obviously, Germany really being, I guess, the engine room of the European economy there. Bearing the brunt, so just keeping a bit of an eye on some of those markets just for interest's sake. But again, they are the sorts of markets that you can trade through ETFs. All right, so let's go back to our slides, and we'll have a bit of a look at what's coming up for next week in Australia. It's pretty much all quiet. There's no data coming out next week that's of serious nature or of high importance for the Australian market. Over in the US, we've got the flash PMI on Tuesday night. We also have durable goods orders. Now, Jeff, durable goods orders, just remind us what they are.
Yeah, so what we're talking about here is major asset purchases. So things, a good picture there, obviously, things like machinery.
Yep.
And so it shows it's a reflection of business confidence, investment levels, and make sure if you are paying attention to that data to look at core durable goods. There's a lot of lumpy, major asset purchases you don't make every day.
Yep.
So there's a lot of categories in there like aircraft and military spending. So you don't order submarines and planes every day, so normally strip those out, look at core durable goods, and that's one of the most important pieces of data in the US.
Yep.
As you mentioned, not much really happening in Australia next week.
Yep. So I guess that on the back of the Philly Fed Manufacturing Index survey this last week, maybe the sort of data that the Fed might be looking for. So in China, we've got the HSBC flash PMI there on Tuesday. Potentially have an impact on our local market.
Yeah. I mean that's I've mentioned many times before, that's the really important indicator for China. That's struggled for the last few months. It's been below 50, which is the line in the sand. I'd expect that to continue, but I'd want to see a reading of sort of 49 or higher. If that fell anywhere sort of past below 49, that'd be show a sign of slowdown in China, and that'd impact commodity prices. Our market will take a hit, so I'd just pay attention to that one, in case that does disappoint.
Yep. And the Eurozone there, we've got a number of PMI meetings coming out, the flash services and the flash manufacturing, both in France and Germany.
Yeah, so you've got 4 different PMI numbers, just to confuse you. The most important one would be the manufacturing PMI in Germany.
Yep.
I think that's actually been above 50 for the last few months, so definitely want to see that at around 51 or higher.
Yep. Okay. All right, so data mainly overseas next week. Eurozone, China, obviously potentially having an impact on our market. The US, some important data there that the Fed's going to be paying a bit of attention to. As we get closer to those potential interest rate changes, Jeff's got some research that he's been doing on the last time that we had interest rate changes over in the US. One thing I keep thinking about is whenever we have an interest rate change in Australia, it always seems to be 0.25%. 0.25 basis points. In the US, they're not going to do a 0.25 basis increase. Are they or aren't they?
No, I think they will.
They will, that much?
Yeah.
Okay.
Yeah, so, and I think they'll get, I think they'll move them by 0.25 0.25 increments.
Yep.
But the key is they'll probably be moving them fairly slowly.
Yep.
So yeah, they won't necessarily do the minuscule increases.
Yep.
But they'll space them out.
Okay. So the first one you think would be a 0.25?
Yeah, look, I think they'll probably go, right now they're technically between 0 and 0.25. They'll probably go to 0.25 and then 0.5 from there on.
Okay.
Just one thing actually to pay attention to next week in Australia. We don't have data, but if any of you have heard of tax loss selling, so we should, or tax selling, so there'll be a bit of... people will be motivated sort of buying and selling some shares according to sort of whether they're making money or not, and starting to think about their own personal profits and losses for the year. I'll be putting something out for my Elite Investors Club members on the topic, but certainly for everybody else, give it a Google, or for my club members, I'll be putting something out for you fairly soon, just to keep an eye on that. So that I think you'll find next week some Aussie shares will be moving around, particularly at the smaller end.
Yep.
You might see some unusual moves in stocks late next week, even if there's no news. Just so putting out the warning for you.
Yep. Okay, thanks for that, Jeff. Very handy tips there for everybody. All right, that's it for us this week. Thanks for joining us, Jeff, and providing all that information. Again, keep an eye on your inboxes. We will be doing some promotional webinars telling you some further details about our Elite Academy. But that's it for me. Thanks for sitting with me, Jeff. Have a good weekend. Have a good weekend, everybody out there, and we'll catch up with you Monday morning, 9 a.m. for the weekly analysis session. Bye for now.
Thank you.